Good day, students. Welcome to study unit 2 of financial management. Today we're going to do the conceptual view of financial management. Remember our last class, we did the introduction to financial management where we looked at the relationship between basically key players within an organization. We looked at the relationship, the difference between what is a financial accountant compared to what is a financial manager. What is a management accountant compared to an economist, and what is a tax accountant compared to, right? So that's what we looked at. Today we're going to get a conceptual view of financial management. After this study unit, you must be able to know what the financial management is and its environment. You must be able to know the role of a financial manager, the agency problem and solution, and the financial management principles. Okay, financial management and its environment, right? Remember when we looked at our last study unit, what was one of the key roles of a financial manager? It was to create wealth, right? So now, how does he do it? He needs to increase the value of the company, right? That's creating wealth. And by increasing the value of the company, he's basically increasing the owner's wealth. Because if you invest in a company and the value increases, you need to know that your wealth will increase. How does he do that? He needs to look at investing in assets that will add value to the company, and he needs to keep the company cost of capital as low as possible. Now, let me explain what is cost of capital or company cost. Now, company cost is the financial manager needs to look at how much it's going to cost the company if, one, he uses the company's money. And when you use the company's money, this is called equity. Two, if he borrows, and this is actually called debt, and this is someone else's money. Let's say it's the bank's money. Now, before you can, let's say a financial manager wants to now invest in a company. Finds the building, he's got the plan, he's got the target market. But now he needs to get the money. So he says, okay, if I use the company's money, right, let's say that will cost me 10%. Now remember, it does cost you because you are not the only shareholder. So by costing you means if I allow the financial manager to use my money, I'm not going to get a bonus, so I'm not going to get a dividend, right? So let's say that will cost 10%. Two, if I go and borrow. So it depends on which bank you go to. Let's say Capitec says, you want to borrow R1 million, Capitec says, I'm going to charge you 15% interest. You go to ABSA says, I'm going to charge you 14% interest. You go to FNB says, I'm going to charge you 14.5% interest. Okay, so let's write this down. Capitec will charge you 15%. ABSA says they'll charge you 14%. Standard said they'll charge you 14.5%. FNB says they'll charge you 12%. Automatically, you will rather go for FNB. They're charging you the lowest cost. So then you're going to say 12%, and then you need to add this up. So how much is it going to cost you? In total, if I use equity and debt, it's going to cost me 22%. But now I'm looking and I'm seeing how much return am I going to make on this new project. And then you decide or you discover your return is, let's say, 17%. Then the financial manager needs to decide, is this project worth it? Now, according to me, it's not worth it. Because your profit, which is the return, is actually less than what you're actually going to pay to get the money. So, as a financial manager, I will then say, okay, this project we will skip for now because it's going to cost us more money than it's going to cost or get us money into the company. That is what is the cost, the company cost, or they call it cost to capital. Financial manager's role. The role of a financial manager is to make investment decisions. Like the financial manager decided previously, we're not going to take this project. Why? Because it's going to cost us more than profit that we're going to make. It's going to cost us 22% interest, and yet we're only going to get 17% interest back. So making an investment decision, the financial manager then says, no, we're not going to buy into this investment. We're not going to do this. He makes financial decisions, how to pay. Remember, he decided he's going to take F&B because F&B is the lowest. That's a financial decision. How to pay. Ensure profitability, meaning he needs to make sure that the income is more than the expense. Because if it is the other way around, the company is not profitable. He needs to ensure there's a positive cash inflow, meaning the money you're getting in needs to be more than the money that's going out. Because if you're now paying more money for something than what this thing is making for you, then that's not worth it. Okay, sorry, let's just go back. And then to ensure solvency, meaning your assets, this is what you owe, needs to be more than what you owe people. Okay, now, typical theory question. We can tell you or ask you an investment decision, you need to know it's what to buy. Or we can say the role of a financial manager deciding on what to buy, you need to know that it's an investment decision. We can ask you, give you financial decision, you need to know it's how to pay for it. Or we can say, how do you pay for it? You need to know that that is a financial decision or financing decision. Now the agency problem and solution, right? First thing, let's just read through it and then I'll explain. Conflict of interest between principal, who is the owner, and the agent, who is the manager. The problem is, excuse me, the manager does not act in the best interest of the owner. Now let's just look at the problem. Let me give you a scenario, right? You are the owner of a company. Let's say you've got your safety company, you completed your studies, you're going to open your own business, and you hire me as your manager, right? Now, the first problem is conflict of interest, right? Is there conflict between me and you? Now, conflict of interest is when you now do things on the side. When I do things on the side, right, it's a conflict of interest because there's going to be no relationship between you, that's the owner, and me, that's the manager, right? Meaning that I don't act in the best interest of your company. What's the solution, right? So let's say, for example, you now realize this is what's happening. Or this is actually a good thing to know. Even before you hire or employ a financial manager or any manager per se, you need to already have this in place, right? Solution, managed by means of sound corporate governance. Don't give the person a whole lot of rules, right? Have it in writing, discuss it, and you agree on it. So meaning there needs to be sound corporate governance. Now, when we talk about sound corporate governance is you need to get someone to check the manager. You can't just tell him, you must do this, you must do that, but there's nobody that's checking if it is actually done, right? The second one is to provide appropriate incentive schemes. For example, economic value-added concepts. Management wealth links to owner's wealth, right? So basically that means you come and you tell me, for every sale or sale target that you make, I will give you a 2% increase. So let's say my sales target is 100,000 every 3 months, right? For every 100,000 I go over every 3 months, you say you're going to give me 2%. Right. Now, do you know what the bad thing about that is? I can now get my friends to come and buy just to push up the sales target so that I can get the 2%, and thereafter I say they brought back all the stuff. Meaning that that sale is called fictitious. It didn't actually happen. I'm just doing things, to get the 2%. So meaning if you do ask that, your wording needs to be in place. So you need to say, for example, for every 100,000 of sales target that you exceed every 3 months, that is not returned, in the 4th month, you will get 2%. So meaning, if the goods are returned, the 2%, the manager will forfeit the 2%. Another solution can be share stock options. So the one is economic incentive schemes, and the other one is sound corporate governance. That's the 3 solutions. Sound corporate governance, incentive schemes, and share stock options. Now, management has the option to buy shares within a company. I actually think this is a very good solution because, right, let's say we worked on the number 2, incentive scheme. So you tell me that for everything, or there's no incentive scheme. You know how some employees think, right? They start taking the stuff and then they start selling it back door. Now, if I am only a manager and you are the owner, I mean, what do I have to lose? I'm still going to get my salary. But if you as the owner come and you say there's share stocks available, meaning that I'm going to sell to you 10% of the stock. Now remember, before I bought the stock, I was only a manager. After you sold me the stock or shares in the company, I now become a part owner. Now, which owner will steal from himself? So if you have that scheme in place, me as the manager, I will make sure that people don't steal, because when they steal, they're going to steal from me. I'm going to make sure that everything goes according to plan. Why? Because if there is a disadvantage, I will be disadvantaged. So these are the 3 solutions you have when there is, or to avoid conflict of interest between agency, and our agency is normally, the agent is the manager and the principal is the owner. Now we can, in theory, ask you a question and say, identify the problem between an agent and a principal. You need to know the principal is the owner and the agent is the manager. Okay. Financial management principles. These are very important principles, right? The first principle that you'll normally find in financial management is called a cost-benefit principle. Now, what this principle does, right, before the financial manager makes a decision, he needs to look at the cost of the resources. Remember the example of the cost of capital, the company cost? First looked at how much it's going to cost, and then you're going to compare it to, if I invest in this product, how much is it going to cost me, and how much am I going to benefit out of it? So you always do that comparison, cost versus benefit. The second one is called risk and return, right? The higher the risk, the higher the return rate. Like say, for example, let's take the lotto. If you play 100 Rand on certain numbers. And I play 20 Rand on certain numbers, right? Let's say both of us win, you will win a higher amount because you paid or you played or you risked a higher amount than what I did, right? And the other one is time value of money. Now, time value of money, it basically just says it's more profitable to receive money now than sometime in the future. Okay, let me explain that. Let's say 2 years ago or 3 years ago, with 100 Rand, I think you could buy at least 3 Big Macs. Right? Today, with the same 100 Rand, remember 3 years ago, this 100 Rand was blue. The value was 100 Rand. Right? With that same 100 Rand, same blue 100 Rand, same value, today, with that 100 Rand, you can barely buy 2. So let's say you can only buy 1 Big Mac. Now what happened? The 100 Rand remained the same. Still blue. Still value of 100 Rand. But the value or the worth of the 100 Rand dropped due to time. Now, time is always inflation. Now, due to time, now what this concept is actually saying, it's better for me to receive my 100 Rand today than me receiving that same 100 Rand next year. Because next year, I will not be able to buy the same things I can buy now with that same 100 Rand. Now, guys, these are basically just summaries. You need to go to the textbook and you need to go and read to have better understanding of what the cost-benefit concept is or principle, what the risk and return concept or principle is, and what the time value of money concept or principle is. Thank you so much. Till next time. Bye.